If you're retired, planning to retire soon, or already collecting Social Security, there's a very real chance money is disappearing from your benefits every single year without you even realizing it. And the worst part is that most people don't find out until after the tax return is already filed and the damage is done. We're talking about thousands of dollars quietly slipping away through state tax rules that almost nobody explains clearly. Some retirees lose a few $100s. Others lose over $3,000 every single year just because of where they live when they claimed benefits or one financial move they made without understanding how the rules connect together. And here's what makes this even more frustrating. Many retirees think Social Security is tax-free because they already paid taxes into the system their entire working lives. But in 8 states across the country, that assumption can cost you badly. Even worse, there's a second layer buried inside federal law that stacks right on top of the state rules, creating a combined hit that catches people completely off guard. Now, the list actually got shorter in 2026. West Virginia officially removed its tax on Social Security benefits starting January 1st. That sounded like great news for retirees. But here's the part almost nobody talks about. Some retirees in states that reduced or removed taxes are still paying more this year than they did last year because the federal formula keeps pulling more income into the taxable zone. So while headlines celebrate tax relief, many retirees open their returns and discover the opposite happened. By the end of this, you'll know exactly which 8 states still tax Social Security in 2026, how each state decides whether your benefits get taxed, why federal law still reaches into up to 85% of your benefits even if your state does not tax Social Security at all, the new deduction Congress quietly added for seniors, and the specific moves retirees use to reduce or avoid these taxes before the year closes. What makes this rule so dangerous is how invisible it is. Most retirees never receive a notice saying, "Your Social Security is being taxed." Instead, the amount is folded into the regular income tax calculation. It looks like ordinary taxable income. Unless you know where to look, you never realize your benefits were part of the reason the bill increased. There are actually 2 completely different categories of states still taxing Social Security. The first group is straightforward but expensive. These states apply their tax directly to the federally taxable portion of your benefits. The second group is where the real traps appear, because crossing an income threshold by even $1 can suddenly trigger taxes that were completely avoided the year before. The first group includes Colorado, Utah, Montana, and Minnesota. In these states, if part of your Social Security is already taxable federally, the state usually takes a piece too. Colorado surprises a lot of retirees because the state markets itself as retirement friendly, and technically, for some retirees, it is. But there's a catch buried inside the age rules. Colorado applies a flat 4.4% income tax, and retirees age 65 and older can fully deduct the federally taxable portion of their Social Security benefits. That sounds generous until you realize what happens before age 65. Retirees between ages 55 and 64 face deduction limits based on income thresholds. Single filers can deduct only up to $75,000 of retirement income, while married couples filing jointly can deduct up to $95,000. That creates a painful trap for early claimers. Imagine a couple in their early 60s. One spouse starts Social Security at 62 because they needed income sooner than expected. The other spouse continues working part-time to maintain health insurance before Medicare begins. The working spouse's income alone pushes the household above Colorado's deduction limit. Suddenly, the taxable portion of those Social Security benefits gets hit with the full 4.4% state rate. Over several years before age 65 arrives, that couple can quietly lose more than $3,000 to Colorado taxes on benefits that later would have been exempt entirely. Once the money is gone, there's no refund for those earlier years. The timing alone created the bill. Utah operates differently, but produces the same frustration. Utah taxes income at a flat 4.5%, but it offers a Social Security tax credit for lower income retirees. The problem is the credit phases out once income climbs above certain levels. Full exemption applies only for single filers below $54,000 of adjusted gross income, or married couples below $90,000. Once income rises above those levels, the credit begins disappearing. A retiree with pension income, required minimum distributions, and maybe a small consulting job can suddenly lose the credit entirely. Couples just over the threshold can end up paying roughly $1,400 annually on benefits they assumed were mostly protected. Montana sounds simpler because it follows the federal Social Security taxation model, but the thresholds Montana uses are shockingly outdated. For married couples filing jointly, the base amount is just $32,000. For single filers, it's only $25,000. Those numbers were set decades ago and never adjusted for inflation. That means retirees with even modest outside income often find up to half their benefits pulled into Montana's tax calculation. At rates reaching 5.65%, the added cost can easily approach $800 a year. By itself, maybe that doesn't sound devastating. But retirees rarely face just one tax hit. It stacks on top of federal taxes and every other retirement expense already rising around them. Then there's Minnesota, which may be the most complicated state on the list. Minnesota offers a subtraction system that fully exempts Social Security for lower income retirees. Couples with adjusted gross income below roughly $18,320 and single filers below about $84,490 can avoid state taxation entirely. But once income climbs above those limits, the subtraction starts phasing out quickly. Nearly 1 out of every 3 Minnesota retirees still pays state tax on Social Security, and for retirees caught inside that phase-out range, annual costs commonly land between $1,200 and $2,200. So those are the first 4 states. Colorado, Utah, Montana, and Minnesota all create ongoing annual exposure tied directly to taxable benefits. But the next 4 states operate very differently, and in some ways they're even more dangerous because retirees can spend years paying nothing and then suddenly get hit hard in a single year. Those states are Connecticut, New Mexico, Rhode Island, and Vermont. These states rely heavily on income thresholds. Stay under the line and your benefits may remain exempt. Cross the line by even a small amount and the tax activates immediately. What makes this so dangerous is that retirees often cross the threshold because of one-time financial events they didn't realize would affect Social Security taxation. Connecticut starts taxing benefits once adjusted gross income rises above $75,000 for single filers or $100,000 for married couples filing jointly. Once over the threshold, up to 25% of Social Security benefits become taxable at the state level. Retirees frequently trigger this accidentally through Roth conversions. Imagine a retiree who stayed safely below the limit for years. Then one year, they convert $60,000 from a traditional IRA into a Roth account after hearing it was a smart retirement move. The conversion instantly increases adjusted gross income, pushes them over Connecticut's threshold, and suddenly opens part of their Social Security benefits to state taxation. But the damage doesn't stop there. That same Roth conversion may also increase the federally taxable portion of benefits, causing a much larger federal bill too. If that same conversion had been split over several years instead of one large transaction, the taxes might have been dramatically smaller. But once the year closes, the opportunity disappears. New Mexico creates what tax professionals often call a cliff. Single retirees earning less than $100,000 and married couples under $150,000 can deduct Social Security benefits fully. But once income crosses the threshold, the deduction disappears entirely. There's no gradual phase out for many filers. One extra dollar of income can suddenly trigger hundreds of dollars in taxes. A single poorly timed IRA withdrawal or investment gain can completely change the tax picture. Rhode Island adds another twist because the state ties exemption rules not just to income, but also to age. Social Security benefits are exempt only for retirees who have reached full retirement age and remain below certain income thresholds. Retirees claiming benefits early at age 62 often assume the state won't care because their income is low. But Rhode Island still taxes the federally taxable portion until full retirement age arrives. That means someone collecting early benefits for 5 years before reaching full retirement age could pay taxes the entire time without realizing age itself was the trigger. Vermont rounds out the list with a phased exemption system. Joint filers under $70,000 and single filers under $55,000 may qualify for full exemption. Above those ranges, the exemption begins shrinking until eventually the federally taxable portion becomes fully taxable under Vermont's rates, which can climb as high as 8.75%. A retiree taking on temporary consulting income or selling an investment property can unintentionally trigger a major jump in state taxes for that year alone. But now comes the part that shocks almost everyone. But for retirees living in any of the remaining 8 states, the combination of outdated federal thresholds and state-level rules can quietly drain between $1,000 and $3. 000 every single year if no planning happens ahead of time. And the most important thing to understand is this: once December 31st passes, most of the moves that could have reduced the damage disappear with it.